Welcome to another edition of Inside the Economy. I'm Brian Gieman, an advisor at SHJ. Thank you for joining me. In today's edition, we're going to discuss international stock market performance, some recent inflation and personal income data, and follow up with 2025 market volatility. Let's jump into the economic data. Far right side under the March column, we'll see some of the biggest updates here are really to the PCE, the core year-over-year numbers. Now, this was data that was released last week, and what we see here is continuing of what we would call normalization. Those figures came in at a 2.8% level. If we look back going to March of 2024, still in that 2.8% level. So sitting in a slightly higher inflationary environment, but these figures are all pretty darn consistent as we look over the last handful of months and certainly over the previous year as well. Across the other inflationary numbers of importance here, the CPI numbers just above stay consistent right at that 2.8 and 3.1 headline and core number. We saw a notable move in durable goods orders, a slight uptick, although we expect some of that data to continue to move around on us. On the bottom half of the screen, important updates, yet it's also really important to note that a lot of these numbers are staying consistent, whether it's the unemployment figures hovering right around the 4% range, the initial jobless claim figures, which we receive on a weekly basis, hovering right around this 225,000 range, or maybe more importantly, all of the various fixed income numbers below that, starting with the 3-month Treasury bill through the 30-year mortgage, pretty darn flat. Those numbers have stayed consistent. We view this as the entire fixed income world continuing to normalize after significant moves up by the Fed in 2022. Finally here, crude oil, slight uptick from last week, still down a bit going back to March of 2024. So there's some movement on this page, yet we would also say this looks like a pretty resilient economy, not a ton of large swings, and things look relatively healthy from this broad economic report. Moving into a little bit of the international stocks, topic number one. Well, this year we've really seen international doing quite well versus U.S., and that's what this first slide is going to show us. This is depicting the Stoxx 600, which is going to be close to Europe's equivalent of the S&P 500, and we're seeing a beating of the U.S. market by a record, at least in dollar terms here. That's an important note as well, but almost 15 percentage points of outperformance of international stocks and the Stoxx 600 relative to the S&P 500. We'll see if this trend can continue, but it certainly looks to be a really good start and perhaps some swinging momentum towards European shares in particular. Staying in the non-US theme, here we have a 10-year chart going back to 2015 where it looks like the Magnificent Seven and the core technology holdings in the U.S. may no longer be the only game in town. What's particularly fascinating about this chart, going back again about 10 years, is we saw that non-U.S. stock made up almost 50% of global market capitalization, or the way we would categorize the total value of the market. That number's fallen significantly over the last 10 years to sub 35%. So is this a significant move we're seeing on the far right side of this chart and a big uptick back to above the 35% mark, the beginning of a trend? We certainly think that there is some value and additional reasons to be optimistic around international stocks, and we'll see if that trend ultimately continues as well. Within the U.S., however, it's very important to note where is the bulk of revenue coming from within the S&P 500. Now, this chart may come as a little bit of a shock to some folks, where we see almost 40% of revenue from S&P 500 companies is actually coming from the international side of the ledger. Now, is this inherent diversification built into owning just S&P 500 stocks? Well, the first quarter of the year would tell us no, unfortunately. You do need to hold individual European and Asian equities to continue to add that diversification into a portfolio. But just important to note that there's a really healthy balance, even within the US, of the top 500 companies and where they're pulling revenues in from around the world. As we move on to this next chart, we're going to discuss a little bit more on something called equally weighted indexes. Now, this chart shows in blue the S&P equal weight index. What these indexes attempt to do is strip out the large market capitalization that we see when looking at the traditional S&P. So you get big portions of the Magnificent Seven stocks, for example. Both of these charts take a very equal approach and kind of strip out, again, those larger holdings. And here we see a much different story with US versus international. Believe it or not, going back to late 2022, we've actually seen this equally weighted basket of European equities outperforming the US markets. So a different viewpoint, one that certainly shows a little bit of a different story, but fascinating nonetheless that European equities, and specifically the large move you see on the far right side in the orange, have really shown a divergence and started to outperform relative to their US counterparts in 2025. So again, another trend to continue to watch and ultimately see how that materializes through the remainder of the year. Last but not least, we're going to look at a little bit of assets in review. So we have a number of different asset classes here. No big surprise with the volatility that we've seen. US equities, the dollar, and even some international bonds as well as crude are all negative on the year. Some sitting close to their yearly lows, other ones have bounced a bit. On the other side of the ledger, kind of the top half and above of this chart, we see the outperformers of 2025. Bonds, various portions of the fixed income market represented by investment grade corporate bonds or even the debt of emerging markets has outperformed. And at the very top, we see the two superstars of the year, gold and European equities, really continuing to show, again, that divergence. So if we were planning to book our big European vacation, it might have gotten a little bit more expensive with the dollar taking a breather here, at least year to date. But just fascinating to see a nice mix and how we're seeing just a much different landscape in 2025 versus what we have seen over 2024 and 2023 with the US really in a dominant position from a market perspective. All right, let's take a bit of a pause and talk about where the indexes are in the US over the last 1 year time period. Well, the story is still really positive here. We've seen continued growth March of 2024 through March of 2025, albeit as we can see on the far right side of this page, we have also seen some volatility show up pretty much post-inauguration day in late January. We are sitting close to correction territory, meaning a 10% move down since the most recent 52-week high in the S&P 500. We'll talk about that a little further in some slides coming up, but probably a healthy and a normal pullback. Nonetheless, again, still a positive trend and building on strength from 2024 is the view. All right, the inflation figures from last Friday were probably the data point of the week. And on this chart, we see the Fed's preferred inflationary measure, the PCE, or the Personal Consumption Index. Here we see quite a bit of movement going back to the early 90s, certainly the Great Recession right in the middle there. You'll see a big plunge in these inflationary numbers, and then kind of the inverse with the COVID experience off to the far right side of the page and the large move up. We are hovering close to this 2.8% core number on PCE. And really, if we extrapolate this out, we view this as much more of kind of a normalization when looking at this chart, right? We don't see the extremes of 15 years ago or even just a handful of years ago with those two large events. And we think that that trend can certainly continue in this kind of a high 2% range or so. Food prices, definitely a fascinating topic and one that we all experience. Grocery stores or going out to eat. What we think is pretty fascinating about this is specifically when we look at The red all food item, not substantially higher than where it was back in 2015. Elevated by 3.7%, but pretty fascinating to look at that over a decade period and see kind of where we've come and what it truly costs and means to go out to eat or even bring food back into your home as well. Certainly, as we've seen in a couple of charts so far, the COVID time period and the inflationary period that followed in late 2021 and into 22 has a big effect on this chart, but more important, the normalization and kind of those numbers getting back to where they were pre-COVID, I think is the theme that we'll continue to ultimately see. Hand in hand with the inflationary numbers last week is also personal income. At the bottom of this page, we see month-over-month numbers. So we did see that PCE, the personal consumption expenditure, move up by 0.4 in the month of March 2025. That's the bottom half in red. Meanwhile, on the top, we have income moving up by 0.8% during the same time period. The main theme of this chart is continued to show strength in income, folks continuing to feel good about their overall situations. And I think we see this translate to crowded restaurants and packed hotels, as well as certainly crowded flights. So folks still feel good about their situation. It's showing up in their income figures throughout the course of the last handful of years here as well. Let's switch gears a little bit. Let's talk a little bit about the volatility and some of what we've seen in terms of market moves throughout 2025. Now, this particular chart showing the VIX, or the volatility index, sometimes called the fear gauge on various publications, goes back to 2018. So we wanted to encapsulate really two time periods that the Federal Reserve has hiked interest rates. That would be 2018 and 2022. The main theme of this chart is, yes, spikes in volatility, but really not outside of a normal range post-COVID, which is that gray bar indicating the very short recession we saw during the COVID time period. So yes, we are living in a slightly more elevated volatility world from a market perspective. We would certainly say this looks very much in range for what we've seen, and we think that that theme will ultimately continue as we work our way forward. Fascinating chart. So what we wanted to talk about here is bear markets as well as corrections going back to 2008. Bear markets indicated in red shade, as well as the lighter blue showing corrections. And the technical definition there would be a bear market, a 20% or more drop from the most recent peak, versus a correction, which is a 10% or more drop from the most recent peak. What we also see is the amount of days in the parentheses at the bottom of those respective time periods. What we wanted to illustrate with this chart is that corrections, 10% moves, are a normal part of the investing landscape, certainly post the Great Recession in 2008, which is shown on the far left side of this page. What I think is also of particular interest is that even though we have seen a move down in 2025 so far, and we are almost in correction territory in the S&P 500, we don't actually see it showing up in this chart quite yet because we're just not quite there. We're knocking on the door of correction territory throughout this pullback. But we will see as this chart continues to evolve if we end up getting into correction territory, or we continue to see things kind of rebound and move back up after we get through these periods of volatility. Now, what does that all mean for portfolios? Well, we would certainly talk about having a diversification strategy within your portfolio, and that's really what this last slide is going to show for us. From the most recent peak in the S&P 500, again, we have seen almost 10% down numbers, knocking on that correction territory, as we've mentioned a few times. But what's really important here is that we've seen divergence in two other asset classes, 20-year treasuries and various parts of the fixed income world, as well as precious metals like gold, which are both positive year to date. And so those other investments have helped buoy portfolios even in the face of volatility and a pullback in the S&P. So just always a good reminder that we always have a healthy mix of different investments that can help to kind of counterbalance the volatility that we're seeing out there. Well, thank you for joining me in today's edition of Inside the Economy. As always, if you have any questions, please email us at info@shjwealthadvisors.com or call us 303-639-5100, and we would be happy to discuss in further detail. We'll see you next time.